As far as a rate and term refinance, that is a long-term thought process. You need to be thinking, okay, we're going to for sure be here for 7, 10 more years.
Someone had to ask. I'm Amy Fiaclia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't and ask the questions you might not know to ask. Someone had to ask, so I did. I want to start this one episode with a number I think about more often than I'd like to admit. In 2020, we bought a home with a rate of 3.125%. Then we moved to Kentucky, and the home we're in now carries a rate of 6.25%. That gap sits with me. And like a lot of people in that same position, my plan is to refinance, possibly once rates come back down, if the math actually makes sense when that time comes. That's what I want to dig into today. Because refinancing isn't as simple as watching a number on the news and calling your loan officer the moment it drops. There are real costs involved, a break-even point to work out, and decisions that genuinely benefit from someone who knows what they're looking at rather than a calculator online, which is what I've been using as a calculator online and my AI. We've already talked about discount points on this show, and this conversation connects directly back to that one in a way I think you'll find useful if you're weighing that decision right now. So, I wanted to bring Jay Sills in to walk through refinancing from someone who does this for a living. Jay, welcome back to Someone Had to Ask.
Thanks for having me.
Jay, let's start broad. What are the actual reasons someone refinances? Is it always that they're about chasing a lower rate, or are there other reasons that come up just as often?
Well, there's several reasons you can refinance. You can refinance to get cash back, to pay off other bills that you have, other liabilities. That's really popular these days. Anytime you can look at, if you're paying 20% on a credit card, for example, and you have $10,000 in a credit card balances, and you can get $10,000 in equity and have a 6% interest rate. That's kind of a no-brainer situation if you want to go that route. Um, but ultimately, lowering your interest rate long term is the best idea in terms of refinancing. You can do, like I just mentioned, a cash out refinance to pay off other bills, or you can use that money however you want. The bank, we don't dictate what you do with your money. The only thing that we do is follow the guidelines of what's the max we can go to, how much cash back we can get you. Or you can do a rate and term refinance, and that alone can get you maybe out of PMI. And then what we would do is we would look at your break even point, which was we just look at the cost involved and your difference in payment, and you divide those two, and that'll be your break even point in months. It comes out in months if you do it that way to figure out your break even point.
So let's talk a little bit more about what refinancing actually costs. Because when people
Mm.
hear refinance and they think about the rate they'll get, that's one part of the picture. But there are other costs to actually refinancing, even though it might not be as expensive as the initial purchase. What goes into that number? And why isn't it just a matter of like, let's plug in some numbers into the calculator online?
Yeah. So, there's always going to be closing costs. That's what you have to consider. Now, there are options such as a streamline refinance, where you typically would just bring your mortgage payment to closing. Okay, and that'll keep your balance where it is, say today. Um, or you can roll your closing costs in. That's typically not a streamlined refinance. Those would require a full appraisal. Now, a streamlined refinance doesn't require an appraisal, but you can't roll in closing costs. So there's going to be out of pocket expenses. And that's why I was saying that oftentimes your loan officer can set it up where you bring your proposed mortgage payment to closing. So if your mortgage payment is $2,000, that's what you could look at bringing. That's what you would be paying or anyway, or your previous mortgage payment. So you're not going to be out more money, say for a streamlined refinance, if you qualify for a streamlined refinance. Now, a regular refinance still has all of the standard costs. You're still going to have another appraisal. There's still going to be title work. So you're still going to have closing costs. It's not as much, quite as much as it is on a standard purchase with a refinance, but there's still costs involved, significant costs. So I mean, you're still looking at several $1,000s if you're going to roll the cost in. Those are things you got to weigh. If I don't qualify for a streamlined refinance where there's no appraisal and we can keep your balance the same, and you bring just the proposed mortgage payment to the closing table, if you can even do that. That's the thing, is that we just it's always the case by case that I bring up. We just have to see about your situation. But refinancing can be subjective to each person. The rule of thumb: if you can lower your interest rate by 1%, that's a no-brainer. 0.5% is, I think, the minimum. And this you have, and if you're financing, more than 200,000, 0.5% could be a significant advantage for you. But we just have to take a look at it and see what all the benefits for you would be. So, like I mentioned, getting out of PMI and lowering your rate, or cutting the term down.
In a previous episode, you talked about breaking even for a particular loan. And we said, oh, well, discount points and breaking even, that can be in a whole other episode. And you talked about how to calculate that. How do you talk or walk somebody through that scenario about refinancing that initial purchase with mortgage and buying down points, what their timeline looks like? What does that conversation look like or sound like?
Yeah. Well, it just looks like yeah, well, what we do is we just look at how long it's going to take you to recoup the cost. That's all. And refinancing doesn't make sense if you're looking to move within the next few years. You're just kind of, throwing money out the door, because you can't recoup that $100 to $200 a month. It'll eventually get you there, but you have to be in the property long term. That's the whole key. And if you're being honest with yourself and you know that you're going to move, don't. There's no sense in it. You're just kind of throwing money out the door, because unless you're getting cash back, unless you need the money for something else. But as far as a rate and term refinance, that is a long-term thought process. You need to be thinking, okay, I mean, we're going to for sure be here for 7, 10 more years, for whatever reason, and that would be a benefit, because the lower rate and saving 100 to 200 or more per month, it will add up and it'll get you there. And whether it takes 3 years or 4 years, it will always win long term. So that's what we look at, and we can't just refinance someone if there's not a benefit. As the lender, we have to show a benefit, or we can't put the loan together. So we have to show that on every refinance that we do.
Do the discount points apply in this situation? Can someone do that same deal with buying down a rate when they refinance?
Mhm. Oh yeah. Oh, absolutely. You can buy down up to 2 points and you can roll that cost in if you want. It just gets more costly and we just have to look at the break even point. And again, hey, long term, I'm all for it. If you want the lowest rate that you can get, absolutely. I mean, if you know this is the house that you're gonna be in for, I keep saying it's 7 to 10 years or more, then it will always win. You will always benefit long term. But so that's just what you have to come to grips with: is how long are you going to be in the property? Be honest with yourself. Is this a first time home where you know you're going to want more house down the road in less than 10 years? So, but discount points, that's the thing too. If you We talked about discount points, and that's buying whenever you're purchasing a home. So that's another thing. Whenever I would suggest refinancing and not buying discount points, say right now, the way the market is. I would just wait until rates do drop. Um, because your savings are going to be more significant in the long term than it is because it's the what you have to weigh is the volatility of mortgage interest rates and market. It it's a like I've said, it's a moving target, and if rates all of a sudden go from 6.25 to 5.25, I mean we don't know when that's going to happen. And so you just have to evaluate at the time what your needs are, and don't get too caught up on the what ifs. It's all about right now with interest rates anyway. It is. You just have to know what's going on, where rates are, and what your loan officer can tell you, can relay like where are we trending. And like I've said before, I believe the rates will go down. It's just we don't know when.
So that I keep coming back to my own situation in that case because it's like, ugh, gave up such a good interest rate. And then, to be where you want to be and to buy at the time you want to buy, you can't dictate the rate that you get. And, you've got to be okay with that. But looking down the road, there might be a time that the rates, like you said, they'll come down. But after a certain point in time, it won't make sense for us if it's after, and I don't know what that time might be, but isn't that another consideration? Because say they do go down you know, half a point, or they go down a whole percent after 10 years or 12 years or 13 years in a house, you might not really recoup that kind of cost, wouldn't you say?
Yeah, that's true. I mean, I think refinancing in definitely the first 5 years, within the first 5 years, that's really when you want to, in my opinion. Again, now that's just rate and term. There's other refinances that absolutely have benefit. And that's whenever you're talking about getting cash back. You do, to build onto your house or something like that. So, but as far as what you're talking about, rate and term, the first 5 years is really whenever you want to look. But again, it just depends. It totally depends on the person. It depends on like how much you have financed. Maybe, I mean, what if you want to put more money? What if you came in and y- say you inherited $50,000? You know what? I want to put that money in the house. There's nothing wrong with paying $50,000 into your house and refinancing and putting that into your equity in your house. There's nothing wrong with that. So it's just always a case by case. But as a rule of thumb, I think that refinancing within the first 5 years is always a good move.
Very good. So beyond that online calculator, Beyond that math, what does a loan officer bring to this decision that you can't just get on a rate calculator online? What are you looking at that most borrowers wouldn't even think to ask about?
What do you want to do with that extra money? And you know what? If it's just $100, we give suggestions. You could that $100 is going to go towards, you paying off this particular debt because we do look at that. We look at what this can do for you. Even if you're not paying cash, getting cash out to pay off a debt, you say you're just saving $100 a month. Well, you know what? That $100 is a bill somewhere, and that $100 could go towards your credit card bill, an extra $100, or towards an installment loan. Your car will be paid off in for 12 months ahead of time if you just apply that $100 that you're saving towards this other account. So that lots of times is useful, that we stuff that we look at versus, gosh, am I just saving $100? Is it worth it? Well, I mean, it is if you look at it from a bill standpoint. I can take that $100 that I'm used to paying, and I'm going to apply it towards something else. So that's stuff that a loan officer can advise you on, and maybe open your eyes to being like, oh, I can apply $100 to this installment loan, and it's paid off a year earlier. Things like that.
Of everyone you've walked through a refinance over these many years, what tends to
Mhm.
surprise people the most? Something they didn't expect or they didn't know how to ask going into it?
Payoff. Payoff comes to mind. If the balance, if you look at your mortgage statement and your balance is 200,000, that's not going to be your payoff. Your payoff is going to be more than that because you pay for your mortgage in arrears, always behind. So let's just like for you, for example, whenever you make your August mortgage payment, you're paying for July. Okay, you're not paying for August. You make your payment in August, but you're paying for July. So that's why your payoff is more because there's interest that is in arrears, and that's where that odd days interest that we talked about in another episode. There's a daily interest, and that daily interest is going to be added on to the payoff. And that's always the confusing thing. Why in the world is my payoff more than what my balance is? So that's always the one thing that kind of a surprise. Um, and gosh, I'm trying to think of another one other than the typical closing costs. That's always, I mean, most people expect that and know. Um, Maybe that, oh, we've got to pay for another appraisal. We can't use the one we had last year or 2 years ago. No, appraisals are good for 4 months. So, I mean, uh, that's always kind of a surprise that I got to get another appraisal. Or why in the world do we have to get title work again? Well, because it's a new mortgage that's got to be recorded with a new balance and maybe a new bank, new lender. Um, So those are a couple things that always might throw someone off. But payoff being higher is typically um, the one that stands out because that could increase what your loan amount's going to be, your refinance amount. So if you have 200,000 as your balance, but your payoff is 200,750. Any number, whatever the number is, it'll be higher than 200,000, and then you have $5,000 that you're going to roll in on closing costs. So now, so since your payoff is 200,750 plus that, plus the closing cost number, 5,000, let's say, that's always that could catch someone off guard just about what the total loan amount would be or has to be. Because most people just think that they're refinancing and it's just going to be what their balance is and whatever their closing costs come to be, they know they can roll that in. But so that's what stands out to me uh, as far as the question goes on refinancing.
The last question. If someone is sitting where I am, watching the rates, waiting for the right moment, and probably within the next 5 years, hopefully. How do they know when it's time to jump rather than continuing to wait? And let me add on to that. How soon should someone start working with a loan officer to help make that call?
Well, I think that you want to let your loan officer know that you definitely want to refinance down the road. But all of us in my line of work, we watch and we go back and look at what someone's rate is. Whenever we see where rates have dropped and we're at 6.5 and all of a sudden, rates drop and we're down to 5.75. That's whenever I go back and look at everyone that, might could find a benefit. So it's really, as far as you, the consumer, you just need to stay in touch with your loan officer. I mean, the advertisements that you see might be misleading, because I hear it all the time. How rates? I heard on the radio just the other day this advertisement. I'm not going to say what bank, but they said rates have dropped. Rates are dropping, and I'm literally talking to myself in the car. No, they're not. They're not dropping at all. I mean, what are you talking about? So that frustrates me whenever I hear these advertisements. You have to be very skeptical about what you're hearing because lots of times those advertisements are old and they're just being rerun. And because interest rates literally change every single day. I mean, they move a little bit every single day. Every day that I come to my computer and I'm looking at what the bond market's doing, if it's up or down or what. And I mean, rates move. So you just have to be in touch with your loan officer. And really, I wouldn't reach out to anybody unless a minimum 0.5%, but really closer to a full point, 3/4 of a point. That's a rule of thumb. That's almost a no-brainer. If you can go from 6.5 to 5.5, or say 6.25 to 5.5, not quite a point, but 5.5 from is much better than 6.25. That could be a significant um, payment for you, discount in payment, decrease in payment. Excuse me. So you just need to stay in touch with your loan officer.
Very good advice. Jay, I think a lot of people are sitting exactly where I am right now. A lot of people who've bought recently and they're thinking, oh, I thought rates were going down. And
Hmm.
now we're watching and wondering if it's worth acting anytime soon. Do we still watch? And this gave me a much clearer sense of what I actually need to ask when that moment comes. If this helped you think through your own situation or gave you a better question to bring to your loan officer, that's exactly what this show is for. If you found this conversation useful, share it with someone who's watching rates the way I am, or someone who wants a clearer picture before making that decision. If you need help with a question that needs answering, contact me, Amy Viaclia. My contact information is in the show notes and on my website. We'll leave it there for today. Someone had to ask, so I did.